Welcome to the Deep Dive, your shortcut to being well-informed.
Glad to be here.
Today we're really digging into gold. It's an asset that keeps sparking these intense debates, right? Optimism on one side, serious caution on the other.
Absolutely. It's a really complex landscape right now.
So our mission today is to unpack where gold prices might be headed and, what that actually means for you, whether you're an investor or just want to understand these big market moves.
Yeah, understand the why behind the numbers.
Exactly. And for this deep dive, we've pulled together quite a range of material. We've got market forecasts, technical charts, historical context.
And even who's buying it.
Yeah.
Some interesting trends there.
Right, from billionaires down to Gen Z, apparently. So the goal is to sift through all this, pull out the key nuggets, and help you grasp the forces moving gold. We'll look at the bullish calls, but also those short-term warnings.
And that's crucial because understanding those underlying forces is key. It's not just about the price targets. Some forecasts, like we'll see, are incredibly high.
Yeah.
But there are definitely signals flashing caution, too. It makes for a really fascinating puzzle to piece together.
Okay, let's ground ourselves first. Where is gold right now? As of today, June 21st, 2025, we're looking at about $384.40 for a troy ounce. Saw a little dip, maybe a 0.70% from yesterday's close, around $3,408.10.
And what's interesting there is just how much it can move even within a single day.
Yeah.
We're seeing ranges today like $3,356 up to $3,105.
Yeah.
That volatility, that's classic gold.
Right.
Oh, and just quickly, for anyone thinking smaller scale, that's about $108.81 per gram currently.
Good point. Okay, so that's the snapshot, but let's look ahead. Some of these forecasts, well, they really jump off the page.
We certainly do. If we look at, say, the long forecast source, they're projecting gold could hit $4,811 per ounce by December 2025.
Wow, $40 and $11. That's a big jump from where we are.
It is. That's about a 22% increase from the June starting point. So clearly some analysts see strong upward pressure building.
And they don't see it stopping there, do they?
Note, that same source keeps the momentum going into 2026. They're talking a potential close of $4,917 by December 26.
Nearly $5,000. That's almost a 50% gain from June 2025.
A remarkable 49.5%, yeah.
Yeah.
It suggests a belief that, maybe underlying economic issues are pushing investors strongly toward safe havens like gold.
And further out, into 2027, 2028.
Well, for 2027, they see highs around $5,429 by March. There are some dips predicted within that year, but ending December 27 still strong, around $5,422.
Okay.
The most, let's say, aggressive projection we saw from them peaks at $5,911. That's for February 2028.
Almost 6,000. So what about other big players like JP Morgan?
Yeah, JP Morgan Research, according to one source, is also bullish, though maybe slightly less dramatic near term. They're forecasting spot gold could hit $3,675 by the end of this year, Q4 2025.
Okay, still a solid increase.
And then climbing to $4,000 per ounce by the second quarter of 2026. So alignment on that $4,000 level, just maybe slightly different timing.
So what's fueling all this optimism? It can't just be momentum, right?
No, definitely not. The sources point to a few key drivers. Geopolitical tensions, that's a classic one. Conflicts in the Middle East, for instance, often trigger that flight to safety into gold.
Always a factor.
Then there's inflation pressure, which is still lingering, making gold attractive as a store of value. And importantly, shifts in monetary policy.
Ah, the Fed.
Exactly. We're hearing these dovish comments, hints that maybe interest rates won't go up as aggressively or might even come down. That makes gold, which doesn't pay interest, relatively more appealing.
Makes sense.
Plus, you have central banks, like China's, loading up on gold reserves. That's a big signal.
That's institutional confidence.
Right. And historically, gold just does well in turbulent times. Add to that, the technical charts, things like RSI and MACD, which traders watch closely, are showing buy signals, according to some analyses.
Okay, so a pretty compelling bullish case there. But there's always a but, isn't there?
There usually is, especially in the short term.
Some of our sources are pumping the brakes, suggesting caution, maybe even a downturn soon.
Indeed. We saw one source, investing.com, arguing that buyers across precious metals, gold, silver, platinum, might just be, quote, tapped out. Like the buying frenzy has peaked for now.
And here's something that really caught my eye. Gold apparently broke below a key rising support line recently and is actually projected to have a red June, a down month, which is weird, right? Because the U.S. dollar index has been weaker and Middle East tensions are still high. Those usually help gold.
That's a really significant point. It definitely begs the question, why the weakness when traditional drivers seem supportive?
Yeah.
That disconnect, combined with failing to hold above a key level around $3,439 and breaking a short-term uptrend line, well, it suggests the bulls are losing steam right now.
So what levels should people be watching them?
Key technical supports become crucial. The 20-day moving average, which is sort of the short-term trend guide, is around $3,347.
Okay.
And the 50-day moving average, a slightly longer-term indicator, is at $3,340. If gold breaks convincingly below those,
Then what?
then we could see further declines, maybe towards $3,293, or potentially even testing $3,245.
And there was that comparison to platinum too, right? It's suggesting a broader trend.
Yeah, that was interesting. An analyst noted platinum's trading volume peaked on its first recent high, but the second, slightly higher peak happened on much weaker volume.
Meaning fewer buyers were participating.
Exactly.
Oh.
That pattern, where the buying power is drying up, apparently mirrored how platinum topped out back in 2008. The implication being that maybe this isn't just about platinum, but could signal the end of the recent buying frenzy for the whole precious metals group, at least for a while.
It really highlights the push and pull in this market. But stepping back from the day-to-day or even month-to-month, this deep dive really underscores gold's enduring appeal, doesn't it? Its history is incredible.
Oh, absolutely. Humanity's connection with gold goes back thousands of years to the earliest civilizations. It was seen as, well, almost godlike, precious, tied to the sun.
Scarce. Always scarce.
Always scarce. Initially reserved for the elite, and that high valuation, that sense of preciousness, has just echoed through history.
And even today, with trillions flying around the stock market electronically, gold still plays that role of economic insurance, a safe haven.
Precisely. When markets get really rocky, when stocks are plummeting, gold has this history of entering these powerful bull runs.
So why is that? Why wouldn't, say, just holding cash, dollars, protect you just as well?
Well, the issue, as one source explained it, is inflation. After a big crash, people might save aggressively for a while.
Right.
But eventually, spending picks up. If too much money chases too few goods, or if governments print money to stimulate things, you get inflation, that hidden tax. Or, in extreme cases, hyperinflation, like pre-WWII Germany, where currency became worthless.
And gold holds its value because
You can't just print more of it. Its supply is limited by nature and the difficulty of mining it. It inherently stores value in a way paper money doesn't.
Okay, so we know why it's valued, but how does the price actually get set? It seems so volatile.
It's a complex mix. Real-world events are huge. Economic fear, driving stock sell-offs, pushes people into gold.
Yeah, okay.
Investor speculation, just betting on price moves, is another big factor. Basic supply and demand, of course.
And big institutions.
Absolutely.
Huh.
Corporate buying power, large funds, banks, governments are having, their actions can move the needle significantly.
Yeah.
And the value of currencies, especially the US dollar.
Right, the inverse relationship. Stronger dollar, usually weaker gold, and vice versa.
Generally, yeah.
Yeah.
And don't forget the actual cost of production. It takes, get this, about 9.4 tons of earth to get enough pure gold for just a single golf ball-sized sphere.
Wow, that really drives home the scarcity point.
It certainly does.
And there's industrial use too, right? It's not just sitting in vaults.
Good point. Gold's fantastic for electronics because it conducts electricity well and doesn't corrode. So it's in your phone, computers, medical devices. That adds another layer of demand and scarcity.
Plus, as you mentioned, central banks actively manage their reserves, buying and selling gold, sometimes moving away from total reliance on paper currencies.
All these factors swirling together create that complex, volatile price.
Okay, let's shift to practicalities. If someone's thinking about buying gold, they hear spot price. What does that actually mean when you go to buy?
Right. The spot price is the baseline. It's the price for 1 troy ounce of raw, unrefined gold traded on the major exchanges, like right now.
But you don't pay just the spot price, do you?
Almost never if you're buying physical gold. You'll pay the spot price plus a premium. That premium covers the costs of making the bar or coin, distributing it, and the dealer's profit margin.
And those premiums vary.
They can vary quite a bit depending on the product type, the dealer, and even market conditions. It pays to compare.
So that brings up the question, bars versus coins. What's the difference for an investor, cost-wise and maybe purpose-wise?
Generally, gold bars have lower premiums. Their value is tied almost entirely to their weight and purity, the gold content itself.
More straightforward.
Pretty much. Gold coins, though, can have higher premiums. Why? Several reasons. The specific mintage, how many were made, scarcity, and crucially, numismatic value.
Numismatic, what's that exactly?
That's the coin's collectible value, which goes beyond the gold content. It depends on its rarity, age, condition, historical significance, even artistic merit.
Ah, so a coin could be worth more than just its weight in gold.
Potentially, yes,
Right.
especially rare or highly sought-after coins. So while the upfront cost might be higher due to the premium, that numismatic value can also drive returns. Plus, coins offer a practical advantage. You can sell them off one by one if you only need a small amount of cash, unlike, say, a large gold bar.
Okay. And what about things like gold futures? That sounds more complex.
It is a bit more advanced. Gold futures are contracts where you agree to buy or sell gold at a specific price on a future date. It allows investors to speculate on price movements without actually holding the physical gold, or to hedge against price changes.
And those terms bid and ask.
Simple dealer terms. The bid price is what a dealer will pay you if you're selling gold to them. The ask price is what you will pay the dealer if you're buying from them.
And the difference is the spread.
Exactly. The spread between the bid and ask is how the dealer makes their profit.
We often get asked about gold versus silver, too. You mentioned gold is much more expensive, something like 70 times. Why is silver so much cheaper?
Well, a couple of main reasons. Historically, silver just hasn't had the same level of consistent demand as a primary store of value, though it's certainly used. But maybe more importantly, gold is just significantly harder and more costly to mine and purify than silver.
Ah, the effort involved again.
Right. That difficulty factor is built into the price.
What about putting gold in retirement accounts? You hear about gold IRAs or using RRSPs in Canada. Can you actually hold physical gold that way?
Yes, you absolutely can hold physical gold and silver within certain types of self-directed retirement accounts. This allows your investment to grow tax-deferred or tax-free, depending on the account type.
So you get diversification with a real, tangible asset.
Exactly. An asset that, in a real worst-case scenario, could even be physically delivered to you. But always best to talk to a financial advisor about the specifics, especially regarding any sales taxes. Some places charge sales tax when you buy, even for an IRA.
Good advice. Anything else on the practical side?
One interesting point from a source was about reporting. Apparently, gold investments over $10,000 are generally not monitored or reported to the government in the same way large cash transactions might be, potentially meaning fewer sort of overhead costs or complexities compared to some other investments. But again, rules can change, so checking current regulations is key.
Okay, that covers a lot of ground on how gold works and how to think about owning it. But who is owning it right now? Are there any surprising buyers?
Well, the evidence definitely shows it's a popular hedge. Central banks, as we said, are big players, and billionaires certainly seem keen on it.
Any specific names mentioned?
Yeah, names like John Paulson come up. He famously held over $1 billion in gold assets at one point, after his big short during the financial crisis. George Soros, too, made a big $123 million investment in a gold ETF back in 2017, specifically citing a bearish economic outlook.
So for him, it was clearly a defensive move.
A very clear signal, yes. Even Warren Buffett, who has historically been quite dismissive of gold as an investment.
Right, he prefers productive assets.
Exactly. But even he has held shares in gold mining companies at times when gold itself was performing strongly. And you hear about the Saudi royal family, Lord Jacob Rothschild, significant holdings among the global elite.
But here's the part that really surprised me in the research. Gen Z young investors are apparently buying gold.
Isn't that fascinating? Yes, there's a definite trend showing younger investors, Gen Z specifically, are buying both gold and cryptocurrency.
Wow, those seem like polar opposites. Gold, the ancient safe haven, and crypto, the super volatile, new age digital asset.
Right. But they're apparently using both, often for similar reasons.
Yeah.
Diversifying their portfolios and trying to hedge against inflation. It's like they want the stability of gold alongside the potential explosive growth of crypto.
It really begs the question, why this mix? What does it say about their outlook?
It suggests a really modern, maybe quite pragmatic approach to risk. They understand economic uncertainty, maybe distrust traditional systems to some extent, and they're willing to blend old and new strategies to protect and grow their wealth. It's not an either-or approach, it's a yes-and approach.
A really nuanced view. Okay, so let's try and pull all these threads together as we wrap up.
Yeah.
This deep dive makes it clear. The gold market is, well, complicated. You've got these strong, long-term bullish calls, $4,000 by mid-2026, maybe even higher down the road.
Definitely some compelling arguments for the long haul.
But at the same time, we're hearing these very real cautionary notes about the short term. Weak momentum, the potential for a red June, signs that maybe the recent buying surge is over for now.
It highlights that dual nature. Gold remains this incredibly significant historical asset, valued for millennia, right? Scarcity, storing value against inflation, a refuge in turmoil.
Yeah.
And it's clearly not just for pharaohs or kings anymore. It's relevant for central banks, big investors, and now even young people starting out, all looking for ways to diversify and protect what they have in a pretty uncertain world.
So the next time you see that gold price ticker flash across the screen, remember, it's so much more than just a number.
Absolutely.
It's reflecting global anxieties, economic hopes and fears, policy shifts, and it connects back to this metal that's captivated us for literally thousands of years.
So maybe a final thought to leave people with. In this age of, constant information, often conflicting signals, how can you use insights like these from looking deeply at something like gold to better read the subtle currents in the wider global market?
Yeah.
And perhaps position your own thinking, your own curiosity for whatever comes next.